The moving average is one of the fundamental tools in technical analysis. A moving average, MA, is a trend-following or lagging indicator based on past prices. It helps smooth out price action by filtering out the noise from random price fluctuations. The two of the most popular types are the simple moving average and the exponential moving average. The simple moving average is calculated by averaging prices over a given number of periods. For example, the 20 periods moving average would average price levels for the last 20 periods of the chart. On this following bar, the simple moving average would include the last bar of the chart, omitting the one that previously was the first bar in the series. When simple moving average values are plotted on a chart, we obtain a significantly smooth indicator of overall price behavior. The more periods are taken into account when we calculate the simple moving average, the less the simple moving average line will reflect minor fluctuations in market behavior, and the smoother the curve will be. The exponential moving average is calculated by taking the difference between the current price and the previous value and multiplying it by a number dependent on the number of periods taken into account, and the result is added to the previous exponential moving average value. Unlike the simple moving average, the exponential moving average doesn't eliminate any previous price levels from the set when it is calculated, and it appears to be more responsive, reflecting more closely minor fluctuations in price behavior. The most common applications of the moving averages are to visualize the overall price behavior, to identify the trend direction, and to determine support and resistance levels. While moving averages are useful enough on their own, they are also the basis for many other indicators. To see more, please subscribe, give us a thumb up and share our clips.